We got our guest online. He's actually now in Singapore, so without further ado. Report, one of the few on the circuit that shares the title or the moniker of Dr. Doom with me. Mark, welcome to the show.
Thank you. My pleasure.
Now, Mark, you and I, there's the bears out there are generally, split between two camps. One is these deflationists who argue that the dollar is going to gain value, that the price of commodities, gold, stocks is going to plunge, and that we all need to hold U.S. Treasuries. And then there's the other camp, the inflationists, where you and I belong, that say, no, it's the dollar that's going to crash, and so if you're holding treasuries, you're going to lose, and so what you need to own are precious metals, commodities, emerging market equities, things like that. So make the inflationist case for me. Why are you in the inflationist camp and not the deflationist camp?
Well, already a year ago, Janet Yellen, she's now vice chairman of the Fed, said that if one could take interest rates into negative territory, she would be voting for that. It means negative interest rates are basically you deposit $100,000 with a bank, and then after a year's time you only get $90,000 back. Now, this can't be implemented because it would be outright expropriation. But the government can take it away by, say, having zero interest rates or close to zero interest rates on deposits, and an inflation rate of, say, 6 to 10%. And we all know that the CPI figures are heavily massaged, that the cost of living of people is rising much more than what Mr. Bernanke thinks. And actually, just 2 days ago, Janet Yellen came out again with a statement that it would be premature to withdraw the purchases of treasuries, in other words, the monetary stimulus. So my view is, you can have excess capacity, you can have a lousy economy, but you can have inflation for the simple reason that people print money.
All right, we have to hold it there. We have a commercial coming up. We'll be back with more of this interview after the break on the Peter Schiff Show on SchiffRadio.com. Welcome back, and this is Peter Schiff with my guest Marc Faber of Gloom, Doom, and Doom Report, coming to us live from Singapore. And, Mark, one of the arguments that the deflationists make is they always bring up Japan. And they say, look, Japan has had these 0% interest rates for who knows how long, and they haven't had an inflation problem. The yen hasn't collapsed. So we're going to see the worst-case scenario is it's just like Japan. Why don't you buy that?
Well, first of all, the Japanese had continuously a trade and current account surplus, and they had no external liabilities. In other words, the government debt was bought by domestic institutions. That's quite different in the case of the U.S. We have very large trade and current account deficits, and about half the treasuries outstanding are owned by foreigners. So in the U.S., it's more likely that if you reflate, it will succeed than in a country like Japan. And I'd also like to mention one point. At no time between 1989, when the Nikkei peaked out, and today, was there a depression in Japan. It's just that prices moved kind of sideways. There was not deflation like in the depression years of the 1930s. We had essentially sideward moving prices, and incomes were steady. And because numerous items in Japan fell in price, like real estate and golf club memberships and so forth, actually the typical household didn't fare very badly. On the contrary, in real terms, the household sector did quite well. And so the situation between Japan and the U.S. is very different in the sense that in the U.S. we have A, very large fiscal deficits, and B, easy monetary policies. In Japan we had large fiscal deficits, but relatively tight monetary policies following 1989.
Yeah, another thing, people say, again, with comparisons, is you've got these sovereign credit crises now in countries like Greece or Portugal or Ireland, and the conventional wisdom is that we don't have to worry about that because we can print money, that the other countries are restrained because they can't print the euros, and so therefore they have to worry, but that there's nothing to worry about because we have Ben Bernanke, and so America can always pay its bills. Why doesn't that soothe you?
Well, America can always pay its bill. They can print money, but the problem is in depreciated dollars, in worthless dollars maybe one day. And before that happens, obviously people that hold treasury bonds and other corporate bonds denominated in US dollars, as they see the value of the dollar eroding, they will demand higher interest rates. Otherwise, they won't buy the government bonds. Mm-hmm. Now, in theory, the Fed can monetize all the new issues. But obviously, if that happens, then the bond market is toast anyway. And when interest rates in the U.S. will go up, the interest payments on the government debt as a percent of tax revenues will go up, and so the fiscal deficit will actually never come down, but rather go up, in my opinion. So I think that the U.S. has boxed itself into a very unpleasant situation. I'd also like to return to this Japan-U.S. comparison. Between 1989 and 1998, we had commodities deflation. We had the opening of China, and the Chinese were able to export goods at lower and lower costs. And so there were in the world some deflationary pressures. But since 1998, and especially since 2001, as you know, commodity prices have gone up. And now import prices from China into the U.S. are also going up. So we have today quite a different situation than between 1989 and 2000 in Japan.
You know, in fact, Mark, as the statistics, China just released its first quarterly trade deficit and since I don't know when. And the reason for that is because the increase in the cost of the commodity imports that they have to bring in. Now, they're talking about, they're saying that, well, they're importing their inflation from abroad. They're not. Because they're printing so much RMB to buy up dollars, they're creating so much inflation that they're driving down the value of their money. And so oil is going up, steel is going up, and now they're running a trade deficit because of all the inflation they've created.
Well, that is certainly a factor, but we have to analyze the figures carefully, and they haven't been published yet. China may also import a lot of gold in order to bring down its trade surplus or other precious metals like silver. Mm-hmm. So since the figure haven't come out, I don't know exactly what brought about the trade deficit. But definitely we have a slowdown in exports from China. We have a slowdown in the Chinese economy. And obviously a rise in commodity prices make it more expensive for China to import all kinds of commodities.
And, of course, China still has a trade surplus with America, a huge one. It just has a deficit with other parts of the world, which also disproves the myth that the reason that we have a deficit with China is because of the currency, because other countries have face the same currency, yet they somehow manage to have a surplus. Our problems have to do with our own inefficiencies, which were brought about by big government and cheap money and labor laws and the like. But let me ask you a question. One of the reasons that people always say, well, the dollar will never collapse, they say because the world won't let it happen, that they've got such a vested interest, that China has so many dollars, that Japan, that Saudi Arabia, that they will never let the dollar fall apart, that they will continuously buy them because they have too much to lose, that we've got them over a barrel, kind of like mutually assured destruction, and so we can rely on that.
Well, I don't buy that argument entirely. It's true that the world is loaded with dollars. We have, say, total international reserves of $9.5 trillion, and of those $9.5 trillion, probably 70% is held in US dollars by foreign central banks. But the point is this: they will not sell necessarily dollars, but the incoming liquidity, if they have, will not necessarily be invested in dollars. And what they're trying to do, especially the Chinese, is to convert dollars into assets such as oil companies, fertilizer companies, mining companies, and so forth. But the problem for China is, of course, how do you move, say, $2.5 trillion into resource companies? Because nobody will let them buy BHP, Rio Tinto, ExxonMobil, Chevron, and so forth. So it's very difficult for them to move that money. But in general, I would also add to it, yes, China will lose money on its dollar holdings, but it's a small price to pay for all the industrialization they had over the last 15, 20 years, and for all the technology that was transferred to China, and for all the know-how that came to China.
All right, hey, Mark, let me interrupt you. Don't go away. We got one more segment with Dr. Faber on the Peter Schiff Show on SchiffRadio.com, so don't go away.
We now return to the Peter Schiff Show. Call in now, 855-4-SCHIFF. That's 855-472-4433. The Peter Schiff Show.
Welcome back, everybody, to the Peter Schiff Show with my guest, Marc Faber. Mark, let me ask you just a few market-oriented questions in the segment we have left. First of all, on the currency front, the ECB raised rates a quarter point last week. I think they're still behind the curve, but they went from 1% to 1.25%. We're still stuck at 0. What is your outlook on the euro, both versus the dollar and versus other fiat currencies?
Well, I'm not particularly optimistic about the euro, but it's remarkable that it has appreciated so much against the US dollar in the last 3 months, which is evidence that the US dollar is really the worst of all possible currencies in the world.
Yes, losing a beauty contest with the euro.
The second worst is probably the euro, but the US is the champion.
Yeah,
and
I said
you were talking about the rate increase of in the eurozone of 0.25%. I mean, this is going to happen in the U.S. Eventually, they'll increase interest rates, an 1/8% or 1/4% or whatnot. But they're way behind the curve, as you just pointed out. They're never going to have real interest rates that are positive for the next 10 years. So I think that the inflationary pressures will actually build up, and that there is a chance that the U.S. dollar, which has already lost 97% of its purchasing power over the last 100 years, will lose another 97%, but this time in 10 years' time.
You got to be pretty ugly to lose a beauty contest with the euro, but...
Yes, exactly. Yes. That's precisely the point.
What about the yen? I mean, now the yen, we had huge intervention against the yen, which I think was a mistake. It's increasing the cost to Japan of importing all the raw materials it needs to repair its damaged infrastructure. But what's your outlook on the yen versus dollar, euro, and other currencies?
Well, I mean, near term, we had enormous negative sentiment about the U.S. dollar. So it's conceivable that the U.S. dollar rebounds somewhat in the next, say, 1 month, 2 months, and so forth. And in that light, I would imagine that the yen will weaken. I mean, my view was what you should do in Japan is to be long shares, long the stock market, and short the yen and short the JGBs, as the government bonds.
Mm-hmm. But do you think, in absolute terms, do you expect the yen to weaken or strengthen against the dollar and or the euro?
Well, I think over time it's likely to weaken.
Even against the dollar?
Well, in the long run, probably not. But as I said, in the short run, the dollar has become a bit oversold. And, I mean, in the case of Japan, the problem is the government isn't wanting to have a very strong yen on top of the earthquake they had and the tsunami. I think they will monetize the debt, although the Bank of Japan has said no. But I think they'll do it.
Now, what about looking at the share markets? What about China? I mean, there's a lot of talk about a China bubble. Where do you stand on Chinese equities?
There is a China bubble, but as is the case with all the other countries, and that's why I think that we will have inflation, is once the Chinese economy accelerates more than is to the liking of the government, they'll of course slash interest rates and print again money. And this is also the case in the United States and in Europe. The moment the economies will slow down again, or the moment the S&P drops 10-20%, they're going to put the foot on the pedal again and print like crazy.
So in other words, you still need to be long the shares in China or other emerging markets, because any kind of decline will be met with a new round of inflation.
Yeah, I think worldwide, let's say, if you're an investor and you have the different asset classes, cash, government bonds, corporate bonds, equities, precious metals, and real estate, I would be inclined to regard cash, US dollars, and government bonds to be very risky for the next 10 years, that equities will more or less keep their purchasing power as you print money, and that probably, well, right now the precious metals are overbought, but say on a correction, I think that people should increase their holdings in precious metals.
Mm-hmm. Now, of course, I talk about how, the stimulus, meaning the monetary stimulus, is the source of our problems, and that one day we're going to overdose on stimulus in the form of a hyperinflation. I know you talk about the hyperinflation worst-case scenario playing out as well, where we have a real, Argentina, Zimbabwe-style dollar collapse. How do you handicap the odds of that? And if you're going to look into the future, how soon do you think we could potentially be looking at that type of end game?
Well, I think that it's important to understand that the geopolitical conditions in the world have worsened very substantially, and that the Middle East is going up in flames. And so if you have a problem in the Middle East, it may not lead to a major war in Libya, because there is not that much involvement by other powers in Libya than the Europeans and the Americans. But say if there were trouble emerging in Saudi Arabia, and then the Americans would intervene and occupy Saudi Arabia to protect the flow of oil, I'm not so sure that the Chinese would like it very much, because they have become the largest customer of Saudi Arabian oil. And so that may lead to confrontation, and therefore we may have much higher military expenditures in the world, which would be inflationary. During war times, commodity prices go up substantially. And if oil prices stay here or go up, then obviously consumption in the U.S. doesn't recover very much, because oil is like a tax on the U.S. consumer. So at this level of oil prices, the U.S. spends something close to $1 trillion on oil a year. That's essentially a tax on the consumer. And so the Fed will then print more money to give more money to the consumer to spend, to stimulate the economy, and that money then flows straight back into commodity prices. I think, quite frankly, Mr. Bernanke is a complete fool, He doesn't have an understanding of what consists of what inflation is, because inflation can have different symptoms. It can be a rise in commodity price, can be a rise in equity price, can be a rise in real estate price, or it can be in consumer prices.
Do you think he has any intention, or whether he intends it or not, do you think QE is going to go away in the summer, like he's saying, or are they going to keep printing?
Well, I think that they will stop for a while with QE2, and if they do, I suppose that the markets will react on the downside. I mean, my feeling is the markets are not acting very well at the present time, and if I had to make a bet right now, as of today, I'd rather be short the S&P than long. But I think he will stop with QE2 to watch once how the markets react. If the S&P drops 150, 200 points, he will print again. And all the hawks who now criticize Mr. Bernanke, if they see their portfolio depreciate in value, will also be
What about in
arguing
the
for
bond
more money
market?
printing.
Is he going to watch the reaction of the bond market? If bond prices fall and rates start to rise, will he, backtrack and start buying them?
Yeah, sure. But there is no clear evidence that the bond market is very dependent on quantitative easing, because last year, in 2010, quantitative easing stopped in April, and after April, the stock market went down, but the bond market rallied. And when they announced QE2, the bond market started to weaken, the stock market rallied.
Yeah, we got to cut it off here. I understand you got to go. Mark, appreciate you coming on the show all the way from Singapore. Keep up the good work. Stay out there. You're a great guy. You're one of my heroes.